All right, so chapter 7. I alluded to some of this in the last chapter when I kind of took a couple of our examples. I extended the explanation on a couple of our examples where I said, okay, well, let's pretend that we sold this thing now that we've depreciated it. That's what we're going to talk about here. How do we calculate gains and losses when we dispose of assets? Okay. Now there are different types of assets that we have. We've got to go through different classes of assets. We're not talking in this chapter just about business assets, although we are going to talk about business assets. So business assets being things like equipment, furniture, anything that you're using in a business, what happens when we dispose of them. So that's one class of assets that we're gonna discuss. Another class of assets are called capital assets, and these are items that are personal, like your personal car, your personal house, that sort of thing, or investment as well. So if it's just purely for investment purposes, so maybe some stocks and bonds, or you've got a piece of property that you bought, expecting it to go up in value, that type of, and that's another class of assets, those capital assets. And then we have a third class of assets, which are called ordinary assets. Ordinary assets are mostly business assets that would generate ordinary income when they are sold. So things like inventory. When we sell inventory in the course of business, we generate ordinary income, right? Or accounts receivables. Well, and I'm going to go into detail on all of these as well. But these ordinary assets are another type of asset. The tax treatment for all of these assets is different. And even the tax rates that are used to calculate any gains or losses on the disposal of these assets is different. So we're using different rules for them and different tax rates for them. Okay, so we've got to first look at some of the tax forms that are used when we sell these assets. The first one we're going to look at are property transactions. We're going to go into a little bit more detail about these three classes of assets. Ordinary assets, which I just mentioned, anything that would generate ordinary income in the ordinary course of business. What are called 1221 capital assets. So now we've got more numbers that we have to remember. Okay, again, these are section 1221. These are capital assets, investments. Section 1231, business assets. These are assets that are used in a business, so equipment, furniture, that sort of thing. We're going to talk about the tax rules for recognizing gains and losses first on the sale of ordinary assets. This is the easiest one, the sale of ordinary assets. You actually already essentially know how this works because we looked at that Schedule C, and on that Schedule C, if we're selling items, we're selling ordinary items, right? Items of inventory. But within that, we do have a couple of other types of assets that can be sold and that are under this ordinary asset umbrella. Next one we're going to look at the tax rules for recognizing short-term and long-term gains. So this is one of the differences here with these capital assets. Something kind of unique. We've got a distinction between how long we've held them, right? That distinction results in different tax rates that are applied to these assets. Short-term and long-term gains or losses on the sale of capital assets. Remember, those are personal items or investment assets. So I said, not only do we have a distinction between whether we've held it for a short period of time or a longer period of time, we also have a distinction between how losses are treated versus gains on these particular types of assets. Next learning objective, we're going to look at those business assets, the 1231 business assets, and including, again, here's more code section for you, gains and losses, recapture provisions of 1245 and 1250 property. We'll define what those types of property are. I talked a little bit about the idea of recapture as well in the last chapter when I was talking about the section 179 or the special depreciation. If you have taken all that depreciation up front and then you dispose of the asset before it would have fully been depreciated, you've got to recapture as income that depreciation that you took. That's that additional section 179 special depreciation that you had taken. And then we're going to look, the last part of this, we're looking at some specific types of transactions. In particular, block stock sales, capital gain distributions. These are all like investments kinds of income. Sales of mutual funds and how exactly mutual funds work. Worthless securities, so if you've got a security that is no longer worth anything, how do you treat that? And then sales of property that was received as a gift or through inheritance as well. So you didn't purchase it, you obtained it in some other manner. Okay, so those are the learning objectives that we're going to look at in this chapter. I don't need to go through this, but I do want to pull up actually. Let's look at the form 4797 real quick.